Hello, everyone, and welcome to the Currency Exchange, a NatWest Markets podcast all about foreign exchange markets. If this is your first time listening, I want to welcome you to the podcast. This is actually a weekly series, but today we're doing a special all about the outlook for the year ahead in 2024. So just to set the backdrop, we think 2024 is going to be a year of challenges, but also a year of opportunities. Looking at global growth, we're expecting 2024 to be another year of slowing growth across major economies. In fact, in most cases in the major economies, we're actually below the consensus in terms of overall growth in the year ahead. But that slower growth likely also means inflation convergence on central bank targets in a number of cases. Among the major economies, we see scope for inflation convergence to happen faster and in some cases more aggressively than central banks are currently signaling. So that can set the stage for central bank policy to look a lot different in the coming year than it has in the past few years. The last few years, including 2023, have really been defined by the speed and scope of tightening cycles globally, with the US in particular really setting the bar in terms of hawkish out delivery to the benefit of the US dollar. But 2024, we think, could look a lot different, where a number of central banks are likely already at their peak in terms of policy rate and may start to begin the process of normalizing interest rates in the other direction. Now, this backdrop is one that creates a very interesting dynamic across global currency markets, where you have the possibility of rates starting to come down, which is normally good for risk-sensitive and cyclically sensitive currencies. But at the same time, you have a slower growth outlook and one that can normally lean against that. And so you're looking at a very interesting outlook. And to discuss the outlook for 2024 and so much more, I'm very happy to be joined by my colleagues in global currency strategy here at NatWest, including Paul Robson, who covers G10 foreign exchange with me, and Alvaro Vivanco, who leads our EM FX strategy team. So thank you both for joining. Paul, I want to bring you in first. So if you could, please talk us through some of the themes that you're seeing in Europe, and what do you think are some of the top views as we head into the end of the year and into 2024?
Yeah, I think Europe fits very nicely into that sort of framework that you've set out for global currencies, this transition from a tightening cycle to an easing cycle via a plateau in rates, where we're just trying to work out the sequencing of those central bank moves to easing. And I think for Europe, you have the whole range of those sort of sequencing in central banks. You've got the prospect, at least, that the ECB goes first, one of the major central banks to ease policy. But you could even have the Bank of England being one of the last to cut rates right at the end of the year. We'll leave the Bank of Japan to the side. And within that, you've got this relationship between policy expectations and the currencies. So euro sterling, euro dollar, sterling dollar have all tracked relative yields relatively closely during 2023. And we expect that correlation to persist into 2024. And I think that's going to dominate. At the same time, I think for European currencies, and again, I would sort of include the yen in this, and that's something that I think you might like to explore later, is this idea that some of the biggest movers in 2023, it sort of reverses in 2024. And for European currencies, that's the Swiss franc, which was one of the strongest currencies globally. And we think that the central bank, the SNB, has called time on targeting inflation or getting inflation lower. And I think they've are confident that inflation is going to come lower. That means the central bank that is no longer supporting the Swiss franc and potentially important. In Sweden, Swedish krona has been one of the worst performing currencies of 23 because of fears about higher interest rates and the impact on the property sector. And you've got the prospect of a virtuous cycle there, that as the central bank eases because inflation's coming lower and growth is lower, that the Swedish krona actually does relatively well. And I think that that's something to watch out for in the coming 12 months. For the two major currencies, the euro and sterling, I think for the euro, it's going to be a really challenging year. Even though other central banks are easing, they're going to be the ECB is going to be at the vanguard of this policy easing cycle at a time when growth is weak And Europe is being squeezed. On one side, in the US, you've got the Inflation Reduction Act, China, competitive access to cheaper energy than Europe. So that combination could see the euro trade really quite weakly, certainly in the first half of the year. For sterling, I think it's all about just nominal yields. And as I said at the sort of opening part of this part of the podcast, that we think the Bank of England might not cut rates until sort of August next year, a time by which we think that some of the other central banks are really cutting rates quite aggressively. And I think that might support the currency and be a surprise to the sort of relatively bearish consensus. The other key for sterling is this idea that there's not a specific story for the UK for the coming 12 months. Last year, it was European energy prices, and sterling was very weak. That reversed through the year. Before that, it was COVID. Sterling was very weak, a very large risk premium because people thought that it would damage the economy. It then recovered. And then before that, it was the withdrawal agreement, Brexit, fears of a no-deal Brexit. But our long-term valuation work, when we look at sterling and all the major economies, suggests that sterling on a long-term basis is more fairly valued. And I think that's important. So it's going to be this traditional combination of yield and growth. And this is where maybe the story gets a little bit more sort of bearish for sterling, or where the risks lie. So while we get nominal rates are supportive, hot money flows into the UK that offsets a current account deficit, growth is set to be really quite weak. And in fact, on the consensus at least, the UK could be the worst performing G30 economy. And it's that picking that balance between yield and growth. And what I see for this year, it's been all about nominal growth and not really very much about real yields or relative growth. So I think sterling actually does relatively well, and we could actually see euro sterling starting the year really quite weak, sterling doing relatively well.
Yeah, in this dichotomy between relative yields and relative growth, where yields have done so much of the heavy lifting, and it makes for a very difficult outlook, I think, for a lot of currencies sort of in this realm.
So I think what's going to be also very interesting for European currencies is obviously how they trade against the dollar, because the Fed is normally central to this sort of policy cycling globally. So Brian, how are you seeing the dollar as we move into 2024 after it had a really good year in 2023?
Yeah, it really did have a good year, especially in the back half of the year. We're talking a lot about relative growth and interest rates, and those two have really been pushing in favor of the dollar really since the summer of 2023. Growth in the US has outperformed pretty consistently. The strength of the consumer in particular has been quite strong. And you've also had, that strength has been happening against the backdrop of slowing elsewhere. You've had a slowdown in China. You've had weaker growth coming through in Europe, Paul, as you mentioned. And so relative growth and relative yields are probably going to be the two big factors to watch for the dollar next year. On the relative growth side, our outlook of slowing growth globally is generally consistent with a strong dollar. So if you look at, we have a growth basket here where we track different PMIs, changes in PMIs over time, and that correlates pretty well with movements in the dollar. And I know, Paul, that you've also looked at Eurodollar and its connection with relative growth between US and the world. That tends to have a pretty good relationship as well. So the dollar is a safe haven currency with very high yield, and in an environment of slowing growth, that tends to be a positive for the dollar. So as we head into the year from a growth perspective, we're looking at probably a positive net picture from the growth side. I do think it's probably fair to say that the scale of dollar exceptionalism style outperformance is probably going to wane. We've had 3 straight months of pretty consistent upside surprises in US economic relative to expectations, whereas you've had downside in Europe and China and elsewhere. I think there's probably scope for that to maybe moderate a little bit as we head into next year. We do think the US does start to slow as we head into early and mid next year. So perhaps the scale of that relative outperformance starts to moderate a little bit as the US economy maybe falls a bit back to the pack. But in an environment where everyone else is slowing in tandem, that's probably still going to be a positive environment for the US. And we think that's probably positive for the dollar, especially through the beginning of next year. What starts to complicate the story for the dollar is from the Fed side, and specifically the case for Fed easing. So our expectation, as I mentioned at the outset, is that US growth starts to slow as the global economy slows, and you start to see meaningful convergence on target in inflation, and not just in the US, but also in many different economies. And so with inflation coming back down more meaningfully towards target and growth starting to show signs of slowing, we know the Fed is already a bit worried about the pass through from financial conditions. There's uncertainty over how long those pass through would take, how hard that eventual tightening of financial conditions does hit the economy. We do think the Fed's going to start to be in a position to ease policy around the middle of next year. Our expectation is the May meeting of next year is when the Fed begins its easing cycle. But relative to the consensus, we're actually quite a bit more aggressive in terms of the Fed easing cycle. Our thought process here is that once the Fed is confident that the policy rate has done sufficient tightening, that when the easing cycle starts, it's likely going to be quite rapid. So we actually have them cutting fairly aggressively over the latter half of the year, over 200 basis points of easing by the Fed over that time. Now that leaves the Fed funds rate above the neutral rate estimate at the end of the year. But that's still something that's quite significant because growth has been pushing in favor of the dollar recently. That probably continues into early 24. But relative yields, which have also been pushing in favor of the dollar recently, we do think that starts to turn as you get into the middle of the year. And so for the dollar, we think that the backdrop is it stays supported, especially in the near term as growth slows, but the Fed has not yet begun easing. But as that easing cycle materializes and is delivered faster, that could lead to some weakness in the dollar down the road. Now, I don't think we're expecting a huge turnaround in the dollar. I don't think we're expecting a lot of the full scale of its post-pandemic gains to be offset just based on the Fed alone. One thing to consider is that first, the global growth environment probably is not going to be very conducive to a broad rally in cyclically linked currencies, even if the rate side from the US is getting a little bit less punitive. The other side is we have to be wary of the possibility that if our Fed call is right and that the Fed is easing a bit more aggressively, maybe that gives the green light for other central banks to be moving in tandem. The growth environment that's prevalent globally in our Fed outlook, if the Fed is easing aggressively, that probably means the rest of the world isn't doing particularly well either. And so, Paul, you mentioned it. We actually have the ECB as the first central bank moving in terms of easing next year. And so from a Eurodollar perspective, we're not seeing a lot of rate convergence that would be favorable for the euro. So a lot of different factors at play here, but we're thinking the relative growth picture probably dominates in the beginning of the year. Rates start to take on a larger role in the dovish direction for the dollar down the road as we head further into 2024. But for the dollar, it's all about timing. We know that the yields are very, very high at the moment, and so carry is punitive. And so the timing of that's going to be very significant. We think those risks start to become a little bit more prevalent in the second quarter of next year, heading into the back half of the year.
Yeah, so it definitely feels like the dollar's going to be pretty central. And like you say about the policy sequencing and when that first important Fed rate move comes, will probably be the defining rate move of 2024. So just watching that seems like it's going to be key. So we've already touched on some of the European currencies and how they're going to play out against the dollar, maybe euro dollar a little bit higher by the end of the year, maybe sterling dollar, but a lot of that is the dollar doing the work. I was just wondering, given that sort of likelihood of quite a lot of divergence and differentiation in inflation and growth and central bank reaction functions, which are going to be important against that backdrop of relative growth, which still remains really important as a currency driver, how you're looking at the yen and the commodity-based currencies that seem to be taking their lead from those sort of drivers as well.
Yeah, so the yen is probably the most interesting one because of the changing of the guard in terms of policy rates. Interest rate divergence in favor of global currencies against the yen has been the primary driver of its weakness now for several years, effectively. That the Bank of Japan has had this super dovish policy with yield curve control and negative interest rates, while the rest of the world has been tightening very aggressively. Now, this is, of course, not a new story. It's one that's been ongoing, and it's been one that's been a challenge for the yen. And, as we record, we're bumping up against multi-year highs in dollar yen based on these yield differentials as really the primary driver of that weakness. And so what we're thinking for the yen next year is that in the same way that global policy tightening cycles enhance the pressure, the downside pressure on the currency, some alleviation of that pressure from the global side could take off some of that pressure. And so if you have the Fed easing, you have the ECB easing, eventually you have the Bank of England easing, you have a bit less upside pressure, downside pressure, I should say, on the yen coming from that side of the interest rate differentials. But you also have the Japan side. Now, the BOJ has made some small but important changes in its yield curve control framework. It's been steadily moving away from yield curve control as interest rates have gone up, and the Bank of Japan's been uncomfortable in defending it. Wage inflation has shown signs of moving higher. Inflation has been high, and the authorities there have been taking fiscal stimulus to try and help Japanese consumers bear the brunt of high imported prices. Taking all of this together, we actually think the Bank of Japan is going to be a global policy outlier, but in a different direction in 2024. We actually think they're going to be hiking their policy rate, eliminating yield curve control and negative interest rates by April of next year, which is consistent with the timing of the important Shunto wage rounds. The Bank of Japan has been very, very focused on wage inflation as a sign of sustainable domestically built inflation. So we think the timing of those wage rounds, that gives you a pretty clear indication of how much inflation expectations are feeding into wage setting. I think that's going to be a pretty important moment. So we do think interest rate convergence can help support the yen on a thematic basis. Some of the other currencies to watch in region, the Antipodeans, we continue to think that there's risk to the downside here from the perspective of relative monetary policy and also from regional growth. We think this is a year where China growth continues to sort of muddle along at lower levels. Certainly risks from the property sector have been quite high, and they've really stood out this year. The sort of post-reopening euphoria in terms of China growth expectations really took a hit in the summer, likely to continue to do so. So we think it's going to be a challenging year ahead for China, and for the Antipodeans, where there's clear linkages there. That's a challenge ahead. Not the same for the Canadian dollar, which has its links much more clearly to the U.S. So from a relative value perspective, probably still, at least in the near term, while the dollar stays strong, probably some downside there where the Canadian dollar outperforms better, simply because its regional growth peer, the U.S., is still performing better. But that's something that maybe changes towards the back half of the year if the U.S. story evolves as we expect, with slowing growth and eventually an easier Fed probably leads to an easier Bank of Canada as well. So this, I think, is a perfect opportunity to bring in Alvaro Vivanco to discuss emerging markets. I mentioned China and slowing growth there as an impulse for, as a challenge for cyclically sensitive currencies. We've also talked a lot about interest rates, how they have risen to high levels, probably going to stay there for a little while, but eventually maybe turn a little bit lower as we head deeper into 2024. Alvaro, what are you thinking about emerging market currencies in general as we face this challenging outlook?
Thank you, Brian. It's always a little bit difficult to look ahead more than 12 months. But for EM, I think the case is pretty straightforward, right? So we have a combination of really high interest rates in the US or globally compared to the history of the last 15, 20 years, in an environment in which Chinese growth also is going to be a lot lower than in the past, right? So, in the report, we go into some of the details of this, let's say 4 and 4 or 4.5, 10-year yields being significantly higher than they have been in the past, and China growth being lower than in the last 20 years or so. I think this will kind of unmask a lot of macro vulnerabilities that have been brewing in a bunch of different EM economies over the last few years, including obviously during COVID, but that the market did not really, take out, did not priced in, because yields in emerging markets were so much higher than in the rest of the world. The fundamentals in terms of external accounts and the fiscal were relatively okay. But I think as we move into next year, all those concerns are likely to increase. That doesn't necessarily, spell a disaster for emerging market across the board, but we think that there are a few economies out there in which debt to GDP, for instance, has increased materially since pre-COVID. This has been reflected to some extent in the steepening of the local curves. And obviously, if the Fed moves into an easing, it will provide support to risky assets in general, and emerging markets will participate in that. But we think that there will be a lot more discrimination and a lot more cautiousness on the part of investors before jumping into these emerging market curves, and as a consequence, currencies as well. In addition to that, the current account, external accounts in most economies will be in deficits, not necessarily the extreme levels that we've seen in the past, but again, if we stress the external backdrop a little bit more, right? If we move into a scenario which is not our base case, right, of higher dollar rates, let's say 10-year rates moving into 5% and staying there for a little bit longer, and China growth surprising a little bit to the downside, we think that these are exactly the kind of markets where outright defensive positions can be built, and we can see significant pressure on the currencies. This comes in an environment in which valuations, according to our models, for the vast majority, especially for the more liquid emerging market currencies, are already stretched. They are not at extreme levels, but it's not like valuations are particularly supportive. And some of these details about the external environment can be brushed aside. It already comes following a very strong year in 2023, as central banks, for the most part, have done the right thing. And I think that brings a little bit of complacency for emerging markets, right? Because we really have not seen major crises, right? Currency crises were avoided because central banks did the right thing. But at the same time, kind of the next level of reforms on the fiscal, on pensions, on structural issues have not been undertaken in emerging markets over the last few years. And I think that, again, this environment could bring those issues to the forefront, and people start questioning, the real value of overweight in emerging markets when you have high yields in the dollar, right? And I think that will be the challenge. So there are a few spots that we go into the report. We think that the risks are more towards the downside. In general, we start with a fairly defensive positioning across the board, precisely because emerging markets central banks are already in the easing phase, right? They have started the cycles a little bit before and more aggressively than developed market central banks. A bunch of them are already easing rates. They have been more cautious about the timing and the pace of the cuts. But what we focus on is the disinflationary nature of some of the drivers for EM inflation still being in the pipeline. So when you look at energy prices, food prices, right, with a bit of a lag, they will still spell continuous convergence of EM inflation lower. And I think that gives plenty of space to EM central banks to continue to cut. So it's just a bad combination of factors, from valuations to deteriorating carry to positioning that in a few places is already pretty stretched, as people have been chasing this rally for a long time. And I think over the next few months we could still see more of those cracks.
I feel like that's super interesting, talking about valuations in particular, because I feel like it's, especially for some of the higher yielding currencies in emerging markets, they come in with pretty rich valuations relative to a lot of the growth and cyclically linked currencies that we talk about here in the G10 space, have generally been weaker. And so from a valuation perspective, it is kind of a different story, where EM currencies did perform pretty well in a lot of cases. And so there's some room for vulnerabilities. And also the liquidity story is so important. Central bank and global liquidity is like a tide, right? As that moves out, some of these macro vulnerabilities that tend to get brushed over may become a little bit more important. So some really good points I think you brought up there. Talk a lot about some of the currencies that we think might be under some downside pressure and where there might be some vulnerabilities, and whether it be positioning or valuation. But what are some of the stories in emerging markets that you think are set up pretty well as we head into 2024?
Yeah, that's a good question, right? And I think there are two that really stand out, especially in terms of growth outperformance compared to the history. And that's Mexico and India. In both cases, we think that the external accounts are in pretty good shape. Mexico is benefiting from this nearshoring of Asian production closer to the US. We don't think that necessarily means that the peso will stay at these levels forever. But from a medium-term story, it definitely anchors the fundamentals a lot more than in other countries. In India, the same story from the bond side, right? The inclusion of India in global bond indices will help to bring some more inflows into the local market. We think that inflation growth mix is a decent mix compared to other economies. So just in general, right? We think that fundamentals will anchor valuations a lot more in these two countries. It doesn't necessarily mean that we are long outright versus the dollar, especially to start the year, given what you just laid out for the dollar, but on a relative value basis compared to places like Poland, South Africa, some of the Andeans in which the vulnerabilities, especially in the current account, are high. We think that makes for an interesting mix.
Great. Thanks very much, Alvaro. And thank you, Paul, as well. I think this was a really great discussion, and we'll leave it here. And to our listeners, thank you very much for joining us. As I mentioned at the outset, if this is your first time joining, if you found us through the Year Ahead 2024 publication, this is actually a weekly series, The Currency Exchange, where we do this kind of thematic discussion, not always this long term, usually thinking a little bit more short term as we go week by week. But the Currency Exchange podcast is available on Apple, Spotify, and YouTube. Please consider subscribing to our channels and liking these podcasts. If you do, then you can have early access. You can have the first access to our recordings when they are released. Thank you very much, and good luck in the year ahead.